Wow, so yesterday was the first day that Canadian politicians were back in the office after the summer, and boy, did the government come out swinging with an absolutely shocking set of changes that nobody really saw coming. And these changes will impact pretty much everyone. It's going to help some people, and it's definitely going to hurt others. Whether you own a home, are in the market, or one day want to be, this is going to impact you and your finances. So let's dive in and first go over what exactly these changes are and how it'll impact you directly, and the reason that some experts are extremely worried about one problem that could ruin everything. In short, the changes that were made are going to make it easier to get a large mortgage in order to afford the expensive homes that we have in Canada. As I said, there are some hidden problems to this, but we'll get there in just a moment. The first change is that they're raising the maximum purchase price for insured mortgages. Sounds a little complex, but it's really simple. Let me explain. Essentially, there are two different types of mortgages that you can get in Canada. We can put them in two categories. The first is uninsured. The second is insured, and there are some big differences between them. Let's take this uninsured example first. If you're getting a mortgage from a big bank and you're putting down at least 20% as your down payment, then you don't need mortgage insurance. You can get an uninsured loan. For this example, you buy $1 million home, you put down a 20% down payment of $200,000. You don't need any mortgage insurance, so that's pretty good. Now, things look a little bit different if instead of having a 20% down payment, now you only have a 10% down payment. Because of federal regulations, you have to get mortgage insurance if this is the case. If you don't have as much money to put down in your home, well, technically that loan is more risky for the big bank to give out because there's a chance you're not going to make those payments. You have less equity in your home. So you, as the buyer, need to go and get mortgage insurance from a mortgage insurance provider. And once that insurance is secured, the bank will say, hey, you're not as risky anymore. You've got insurance. We're going to give you this loan, even though you have a lower down payment. But in the meantime, you're paying a higher premium for that mortgage insurance than the zero that an uninsured mortgage would pay. A side note that's going to get important in a little bit is that for these mortgage insurance providers, you might not know that this is federally backstopped. Essentially, if anything were to ever go wrong with these mortgage insurance providers, it would be the government, and as the result, the taxpayers that would be on the hook to make big banks whole if anyone was not able to pay their mortgage, and if these mortgage insurance providers were unable to make the banks whole, they'd go to the government to sort of top up their coffers. We'll explain that a little bit more in a minute. The main benefit of all of this is that by getting mortgage insurance, you can reduce the amount of down payment you need in order to purchase a home. Of course, you still have to show that your income can cover the mortgage expenses, but this does help with that side a little bit because since you get a lower rate usually when you have an insured mortgage, well, those payments are going to be a little bit lower. But for the most part, mortgage insurance and insured mortgages help you out most because you don't need to save as much of a down payment, as large of a down payment. You can get into a home sooner in some cases. And stay with me here because this is going to have some big impacts, these changes that have just been made on absolutely everybody. But historically, this mortgage insurance, there's been a cap on the purchase price of a home if you want to get this insured lower down payment mortgage. The cap previously was $1 million. It made sense to a certain extent. It doesn't make a ton of sense to federally guarantee mortgage loans for mega mansions of like $5 million. So it probably makes sense that there's a cap here. But in some of Canada's most competitive markets, especially during the peak, fewer and fewer homes fell under that $1 million range, as crazy as that sounds to say. So there were a lot of people who were like, well, this mortgage insurance doesn't really serve me because all of the homes in my area are over $1 million. So this cap for insured mortgages has kind of acted like a little bit of a barrier. Unless you can afford a 20% down payment, you weren't able to buy or get a mortgage for $1 million property. But that is where this big change comes into play. Instead of this cap being at $999,999, the government just raised the cap to a whopping $1.5 million. And this is a policy change that in some ways has been a long time coming in Canada. This is directly from the platform that the Liberals put out before the 2021 federal election. They said that a re-elected Liberal government will reduce the price charged by the Canadian Mortgage and Housing Corporation on mortgage insurance by 25%, but here's the important part, increase the insured mortgage cutoff from $1 million to $1.25 million and index this to inflation to better reflect today's home prices. So this idea has been in their minds headlines for a little while. Of course, we didn't see this quickly after 2021 and 2022 or in 2023, and now only in late 2024, we're seeing them come up, raising this cap well above what they promised, all the way up to 1.5 million, and it's raising a couple of eyebrows. Now, this kind of would have made sense at the time, and this is the policy that was coming out during the peak of the housing market. Prices are high, many over the previous $1 million cap. Not only was income qualification hard, but saving the down payment was hard too. This change would have allowed a smaller down payment, albeit for people who could already show a high income to qualify and pass the stress test. But they didn't end up making the change until now, all the way to 1.5 million. And don't get me wrong, there are some positives, definitely, of increasing this cap. It means that people who want to live in high cost of housing areas can now potentially purchase a more expensive home with a smaller down payment and a bigger mortgage. This is going to help some homebuyers get into the market. They're not wrong about that. But the question is, at what cost? And is this a good idea? We'll get into some of my big concerns about all of this in just a minute. The other big change is that these same insured, or in other words, highly leveraged or high debt mortgages, well, these same mortgages are now going to be able to have a 30-year amortization for first-time home buyers and for anyone who's purchasing a newly built home. Now, again, amortization sounds like a complex concept at first, but it's really not. It just refers to over what period of time you have to pay off the entirety of the loan. Like a 25-year amortization means that you have 25 years to pay off your debt, and a 30-year amortization means you have 30 years to pay it off. The big impact here is that by having a longer amortization, each individual monthly payment will be less, even if it means you pay more over the lifetime of the loan. Here you can see the impact really quickly. We have a loan amount of $900,000 and an amortization of 25 years set at an interest rate of 5%. We'll calculate this, and you can see that the monthly payment would be $5,261 on this type of loan. Now, if we stretch that out to a 30-year amortization, the payments change a little bit, about $400, $500 difference. On a 30-year amortization, same interest rate, the monthly payment would be $4,831, but the total of the payments and the total interest would be far higher. And as a concept, this just makes sense, right? If you divide your mortgage into 30 years of monthly payments, of course, that monthly payment is going to be lower than if you had to fit all of those same payments into only 25 years of monthly payments, right? It's going to be lower if you have more individual payments and more time to pay it off. Now, this can also help more people qualify for loans on an income basis, because by lowering the monthly mortgage payment and by stretching out the time they have to pay it off, their monthly income can more easily cover the cost of their mortgage. So this does help in terms of qualification as well. But on the downside, a longer amortization also means that you end up paying a lot more in interest over the life of the loan. And most of that interest is paid in the first few years of the loan, meaning that you, when you're most vulnerable, build very little equity in your home. Now keep this in mind for later. And if I've lost you even a little bit in the last 5 minutes, that's totally okay. All you need to remember up to this point is that the government's latest changes will make it easier for people to buy homes with lower down payments and longer and larger mortgages. Essentially, the government is saying, hey, house prices are super high, so let's make it easier for home buyers, especially first-time home buyers, to take out the massive loans that are required in order to buy such expensive real estate. But here's where the problems start coming in, because while these changes most immediately impact people who are looking to buy, it also impacts every single other person in the market, and it also impacts future generations heavily, future generations who have possibly been further sold out here to gain political favor. And additionally, it opens us up and incentivizes all new levels of fraud within our real estate system. Let me explain exactly what I'm talking about here. You see, with this announcement, the government is making the claim that they've spent time over this summer. They've really heard the valid complaints from millennials and Gen Z Canadians. It's just not easy to afford to live in Canada, and it seems like it's harder now to live in Canada than it was when their parents were the same age they are now. Things haven't gotten easier in a generation, they've gotten harder. And the government has coined this as a problem that they're calling generational fairness. Here's specifically how Chrystia Freeland, our finance minister, describes this issue during the very press conference that announced all of these sweeping mortgage changes.
I think it's, at this point, a truth universally acknowledged in Canada that we need generational fairness. We need to help millennials. We need to help Gen Z. Canada needs to be a place where the dream of home ownership is alive, where a young person who has a job, has a trade, has a degree, is working hard, is one of those 750,000 people who has opened a first home savings account, has a realistic chance to buy a home.
So the stated reasoning for these changes is to achieve generational fairness, but I personally question if this generational fairness is actually being achieved via these policies, or if it's even being worked towards with these policies, because these new changes aren't exactly what they seem. Like, is it simply owning a home or home ownership that denotes fairness? Like, our parents could buy a house, yes, and now maybe with these changes we can take out a bunch of debt and we can buy a house. So automatically, is that generationally fair if we can both have access to the same good regardless of the situation around it? Or should we also consider the circumstances of the purchase to determine whether or not we're getting actually closer to fairness? Like, I think we should be asking, what's the average income to average house price ratio? How has that changed since our parents' generation or the previous generation? How many years did boomers have to be in debt and to pay off their home versus today's extended amortizations? What's the total interest that's paid over the lifetime of the loan relative to the value of the home? I think that these are metrics that would actually point to generational fairness, not just the binary yes or no of do you own a home or do you not own a home. These questions are better to ask when it comes to generational fairness, and in most cases, I don't think that making it easier for people to take on higher and higher levels of debt, and as a result, effectively propping up house prices in the meantime where they are today, I don't think that this automatically makes things generationally fair, even if it does, in the short term, get more people into houses. I think the only way we get closer to real generational fairness when it comes to income to house price ratios is if house prices are given room to breathe. If house prices can stagnate for a little while as we allow Canadian wages to catch up, getting closer to the real generational fairness that would be income to house price ratios. But instead of focusing on moderating the high prices, it seems that they've largely just decided to make it so that people can get into more debt to afford those high prices, which all the while further legitimizes those high prices themselves. And forgive me for getting a little bit ranty here, but I'd also make the argument that this, in a way, sets the nation up for even more generational inequality, right? Because yes, for people on the fringes right now of just barely being able to get a house, but maybe they can't quite, this policy change may push them over the line. But as more and more people are pushed over that line, well, there's more demand, and house prices could respond to that added demand by going up, or at the very least, not coming down as much as they could have. So over the medium term, will this help at all with affordability? Like, will tomorrow's Canadians, perhaps in 10 years, will they be faced with the exact same problem that we're facing today? And will we then raise the cap to 2 million and extend amortizations from 30 out to 35 or 40 years, putting our future generations into even greater levels of debt than the already concerning levels of debt that we're in today? It seems to me that this, along with many of the other financially related problems that we're facing in Canada, the government seems to be just kicking the can down the road. Instead of solving the root issues and addressing the actual cause, we're just going to do a Band-Aid solution that, well, compounds the issue and makes things worse, but we're just going to leave that in the hands of some other government to deal with in the future when we're not in power and when I'm working for some corporation or some consulting agency that values my time in government. Because this policy change today also sends an incredibly revealing message. It seems like the government's saying, not with their words, but with their actions, it seems like they're saying, okay, we admit house prices aren't going to come down. So we're going to make concessions to help more people get into the market at these higher prices. While they might not admit it, this policy props up prices and normalizes these $1 million+ starter homes, which I don't think is great for young families to get into that incredible level of debt unless they have the ability to put down large down payments to sort of start themselves up with a good equity base in their home. It seems like they're saying, always buy real estate. Trust us. We'll bail you out if it goes wrong. If there's a global pandemic, we'll force banks to defer mortgage payments like they did. If prices get so high that you could never sell your home for more than you bought it because Canadian incomes can't support it and nobody can save up for a down payment, a situation that we're in today, well, we'll make changes to let other Canadians take out more debt so that they can afford to pay you even more. Don't be scared. Just leverage up as much as you possibly can. Take on debt. It's safe. This is Canada. This is real estate in Canada. It's a way of life. This is what it seems like the government is putting out there. But it's the message that I'm personally hearing from them, even if they're not saying it overtly. And to be fair, what else are we supposed to think? Like, what are we supposed to think they're saying when they make these actions? The question is, even if they're saying this, should you trust them? What is the risk to you? This is where some big risks start to come into play in the situation because, and I think this goes without saying, allowing more and more Canadians to take on more and more debt with less and less equity in their homes is concerning. I think that's fair to say. More indebted households increase the chance that any possible blips we see in the economy could then be amplified by an overexposed real estate system that's underwater in debt. So yes, things are getting a bit more risky, but who's actually taking on this risk? You might at first think, well, it's probably the buyers who choose to take on higher and higher levels of debt. And you'd be right. Buyers are taking on more risk, but it's not just the buyers. It's also, even if you're not involved in this at all, it's every single tax-paying Canadian. Because with these changes, the government is also, in a way, socializing the risk in the real estate market across every Canadian citizen. We know this, that if you're a buyer, if you're borrowing the absolute maximum amount you can, that puts you and your family at more risk, especially if there's a chance that you might not be able to keep up with the payments. We all get this. It makes sense. But in a worst case scenario where you end up defaulting on your payments and you can't keep up, this would typically be a bad thing for the person who lent you the money for the home. They'd have to go through a power of sale, foreclose on your home, and sell it hoping to recoup any money that's left, any money from that original set of money that they lent. Now, this can wind up leading to some big losses for the banks who lend out mortgages, especially if the houses are worth less than the amount the original buyer borrowed from them. If the banks have to sell these houses at a loss relative to the amount they loaned, then that is not good for the banks and for the Canadian financial system, honestly. But with today's changes, the government has pushed a ton of risk off of the banks. Remember back when we were talking about mortgage insurance? This insurance is paid by the buyer. They're the ones who have to cough up the money and add these extra payments into their mortgage. It's paid by the buyer, but it 100% does not protect the buyer in any way. This insurance is actually designed to protect the big banks. If the borrower defaults on an insured mortgage, if that mortgage is insured, well, then the CMHC or any of these other mortgage providers, they are the ones who have to make the banks whole. That's what paying the insurance was for in the event that the borrower defaults. Now, that's what is being insured. It's an insurance for the bank that even if the borrower defaults, the insurance provider will pay out and they will make the big banks whole. And typically this isn't such a big problem. That's how insurance works. You pay a set amount of money and some actuary math wizard does some calculations on how likely a given event is to happen. And if it does happen, the insurance provider can pay out against that claim because they know that they're going to be making money across all of their files. And this doesn't happen too much. So the odd time that we have to pay out, well, we're still making a bunch of money because usually we don't have to pay out. This is the math that they do. It's a crude description of how insurance works, but you get the picture. But there is a big difference between typical insurance and the mortgage default insurance that buyers pay and that the banks get the benefit of. The big difference here is that these mortgage insurance providers are backstopped by the federal government. Let me say that again. These mortgage insurance providers are backstopped by the federal government. Don't just take my word for it. This is from a report from the C.D. Howe Institute. Again, if you want any of the sources for these videos, I send them out after the video is posted to anybody who's on the email list, which is one of the first links in the description. They say the federal government currently backstops mortgages insured by CMHC, as well as other private mortgage insurers, meaning that taxpayers are ultimately on the hook for a share of losses. Our analysis indicates that a low probability severe housing crash could result in roughly $17 billion of losses for mortgage insurers. Although mortgage insurers' reserves currently exceed the minimum required, these losses would still leave the federal government with a bill of up to $9 billion to recapitalize the mortgage insurers. This means that if for whatever reason a bunch of people default on their loans, and if for whatever reason the CMHC or other mortgage insurance providers can't make the big banks whole, well then since these mortgage insurance providers are backstopped by the federal government, if there was ever an issue with the mortgage insurance providers, well then it would land on the federal government, the feds, to make these mortgage insurers whole, which as a result makes the big banks whole, who are the ones who are benefiting from the policies that the mortgage insurance providers are providing. It's not exactly a bailout for the big banks, it's a bailout for the mortgage insurance providers, but the mortgage insurance providers serve the big banks. So in a way, this is kind of a way that the federal government is backstopping the big banks, reducing the amount of risk that they take on, especially for insured mortgages. And how exactly would the government afford this hypothetical bailout? Well, we certainly don't have the tax revenue to cover it. We barely have the tax revenue to cover the interest on the federal debt. So I think much like at the start of the pandemic, we'd probably see the government go into more debt in order to make these payments. And this debt would be funded by intervention of Canada's central bank, the Bank of Canada, which could print more money via their quantitative easing program to then lend to the Government of Canada by buying Government of Canada bonds, which would give the government enough money to make the banks and the mortgage insurance providers whole. But there's a big problem you might not be seeing here. That problem is that when we print money, and when we increase the supply of money in the system, we at the same time devalue the dollars that average Canadians save. The dollars we all have go down in value, down in purchasing power when there is more money in the system. And on the flip side of that, we also pump up the dollar value of the assets that the wealthy hold, real estate, stocks, other kinds of investments. And this spreading, the devaluing of cash and the increased value of investments that more wealthy Canadians hold, well, that is a big risk at further widening the wealth gap that we already have in the country. If we were to go through another sort of round of stimulus, I think we'd largely see all of that happen again. Now, I want to be clear, don't get me wrong, I think that all of this is very unlikely to happen. This is a worst case scenario, and I believe that the government and the central bank, along with corporations and the banking elite, they'd probably do just about anything to prevent a situation like this, to prevent a housing crash that could precipitate these kinds of defaults in mortgage insurance claims. But with that said, even though it's not so likely, I do think it's fair to take a close look at any additional risk that we're adding to the system, especially when the government is ultimately on the hook for the downside possibilities that come from taking on risks like these. And along the same lines, not to make matters worse, but I think we could be opening ourselves up to even more risk than we realize, because these changes heavily incentivize real estate fraud. Let me explain why. This is something that Ron Butler, who's a great mortgage analyst, Ron Butler's brought this up a lot since the announcement. The idea is that, yes, these changes solve down payment issues. You can buy a more expensive house with less saved money, but it does not solve, does not effectively solve the income problem that most Canadians are experiencing when they're trying to qualify for a mortgage. Even if they can now put down less money, they don't need to save up as much, they still need to qualify and show that their mortgage doesn't take up too high of a percentage of their monthly income. For most Canadians, even with the down payment help that they're getting with these changes, they won't be able to show a high enough income in order to qualify for the mortgage, whether it's insured or not. One solution to the issue is to get as many co-signers on your mortgage application as you can. Use other people's income and have them guarantee the loan. use the incomes of your parents or of other family members and possibly even friends, though that may get messy. And with all of those incomes together, you might be able to get past that income threshold. This is something that we've seen used more and more over the past few years, and it's entirely legal to do, if not risky for the people that you're bringing on. But let's think of the other, less than legal solution, something that's pretty widespread in Canada. If you can fake documents that make it look like you have a higher income than you actually do, and you can use those same documents to qualify for a mortgage, then you can now get a loan for a far more expensive property, since the down payment issue is no longer as large of a roadblock. For example, for a $1.5 million home, previously you would need, at an absolute minimum, $300,000 to put down. That's your 20%. You couldn't get an insured mortgage before, where you could have less than that. But now, with these changes, with an insured mortgage, you'd only need to put down about $125,000, which is less than half of the required down payment from before. So if you now have this lower down payment that's required, but you can't show a high enough income and can't find co-signers to increase that income, well, then you might be even more tempted to go to an unscrupulous mortgage agent who would help you fake your qualification documents so that you can secure this loan even if you technically can't qualify for it. And this is the type of income faking fraud that has largely been reported on by all kinds of news organizations. CBC, CTV, Global News, they've all done reporting on this income faking mortgage fraud. And the government full well knows that this fraud is going on. Back in the April 2024 federal budget that Chrystia Freeland put out, they made a goal of strengthening mortgage income verifications, making sure that people are actually showing the proper amount of income that they're claiming on their mortgage application. And they say that they could do this by linking the mortgage applications to the CRA, where you can just take whatever income you actually filed on your income taxes and then use that number that you filed with the government and that you paid taxes on, use that in connection with your mortgage application, so you're not actually opening yourselves up to this kind of document fraud in order to actually verify income. But this change, even though it's pretty simple, link it to the CRA, check what your income is, this change is still in the consultation phase, which often takes years before the policies get put into place. Just ask anyone with a disability in Canada how long they've been waiting for the Canada Disability Benefit while it's been in consultation or preparation phases. Now, this is what has people so worried. With so much incentive for income faking and such a simple solution, why wouldn't the government solve this problem, this income verification problem, first and cut down on the fraud before loosening the qualifications and before those looser qualifications come into play? Now, allow me to get cynical for a moment and perhaps even a little bit conspiratorial. Take this with a grain of salt. Could it perhaps have something to do with how much money big banks profit from mortgage fraud and how much big banks profit from organized crime and the laundering of money via mortgage fraud? It's a big money business. Why doesn't the government come down on this if they know this fraud's happening? Well, many people believe it's because certain high-up officials have been compromised by international crime organizations that take advantage of this money laundering system through mortgages. These officials are compromised in that they have dirt on our high-level officials. This is organized crime with possible secret links to foreign states who use organized crime to advance their global interests. It might also be the reason that nobody wants to talk about the foreign interference story that's been going on over the past year and a half, and why the person who's in charge over the inquiry into this foreign interference investigation says that they're not actually going to name the parliamentarians who have been reported to have been willingly working on behalf of foreign states. That's all a rabbit hole for another day. Ultimately, with all of this, I think, like most other things, it's more of a play for votes than it is a serious attempt at fixing underlying issues. They know this is a short-term fix, but that's all it needs to be in their eyes. Make people happy in the short term. Hopefully you get reelected, you got their vote, and we'll move on from there and deal with the future when the future comes. Like, on the surface level, when you don't think about long-term risks, All of these policy changes actually sound pretty good for most people. It makes first-time home buyers feel supported. Hey, maybe we can get that mortgage now, even if it means that we're taking on more debt. It reassures people who are underwater on their mortgages currently, maybe people who bought at the peak. It reassures them that they'll be able to renew with the best rate and not have to reface the stress test. And for those same people, and for people who have owned a home for a long time, as well as people who possibly have portfolios of 30 single-family home rental properties, this is the government helping them. This is the government saying that they're going to sponsor home purchases up to $1.5 million via the insurance and the backstopping of the insurance providers that they're doing. This means that your home's value will increase as more demand enters the market, or at the very least, those home prices won't decrease as drastically as they may have otherwise due to these changes. In the short term, there's not too many people who are screwed over by this, and it actually helps most people who are in the market or about to get in the market. But when we look at future generations and say, hey, are we just setting ourselves up for the same problem to happen over and over and over again? Well, then you start to question the policy. In my eyes, none of this really solves the root of the issue. Home prices are too high relative to Canadian incomes, and I'd argue, and I'm not sure that I'm right on this, but I'd argue that a hands-off approach when it comes to the demand side of real estate and a hands-on approach when it comes to incentivizing building would probably be the way to go without sort of intervening here and incentivizing Canadians to get into more debt. I'm not really sure what I think about all of this. I'm curious what you think about it. Do you think that this is the right move? It definitely is going to get people more into the market. Do you think that everyone should just get on for the ride? And if the Ponzi scheme of real estate goes down, well, we all go down with it. So it probably won't go down because they're going to make the changes to make sure it doesn't. Is that something that you believe? Or at the same time, do you say, okay, I'm just going to rent. I'm going to stay out of this. I don't want to touch it. But then maybe are you falling behind if the government is successful in propping it up over the long term? I don't know what to think. I'm hoping you do. Let me know what you think in the comments. If you want to get all the sources for these videos, first link in the description. Also subscribe to the channel if you haven't already done so. About 50% of the people who made it this far in the video aren't actually subscribed, so I'd appreciate you doing so. So close to 100,000, which has been a long-term goal, so I appreciate you doing that. And with all that said, thanks so much for watching, everybody. I really hope this video helped you out at least a little bit, and I'll see you next time.